And hello again. Welcome to the Mark Osler Retirement Experience. My name is Randy Cook. Each week, Mark and I sit down here and talk through some of the issues of retirement that you might be wondering about or concerned about, or maybe you haven't found that person that's going to help you here yet. You know, maybe you went your whole life and you didn't have financial advisor in your life, but now you're getting to a point where you might be a little bit over your head. I know I am going and looking at, how do you develop income? What do I do about Social Security? Then there's Medicare. Then there's taxes. There's so much. And we're going to do this once. Mark does this every single day. Mark, how are you doing?
I'm fantastic, Randy. I hope you're doing well.
Doing well. It is midsummer now, and we're moving our way through, and it goes quickly. It really does go quickly. I'm enjoying the fact that the buses aren't on the road and the traffic's not so bad right now. I like that a lot.
Absolutely. My two youngest girls, 12 and 8, they finished school and everything, and I thought to myself, gosh, I'd blink of an eye, and here we are in the middle of summer already. This has happened so quick. But talk about the weather, too. My gosh, are we going to get a break from the heat?
Is it hot enough for you? Golly. Well, it is an interesting time, that is for sure, when it comes to markets and it comes to retirement planning and all the things that go along with it. So that's really why we're here, to try to help you out with that. And I'm going to use a term here that I think we've used in the past, and that's Tina. And I'm not talking about Tina Turner or Tina Fey. I'm talking about there is no alternative. The people at Goldman Sachs say our appetite for the stock market continues to go up. They looked over the last 10 years at 401k accounts, and they found that more people are putting more money at risk and in the market than ever before. Even people in their 60s. We are returning to Tina, thinking there is no other way to get growth in our portfolio other than dumping money into the stock market. So, Mark, I know that there's another side to that. And are there more alternatives now than there were 10 years ago? Or what are you talking to your clients about if they're really addicted to that stock market?
Yes, and yes. I mean, there's all kinds of alternatives, Randy.
Okay.
First and foremost, let's just discuss this. Yes, people are putting money in 401ks at record pace, okay? Mm-hmm. And I get it, why. In particular, let's just talk about inflation. We've had massive inflation over the last few years. So when you think about the cost of goods and things like that, people feel like there's no other alternative but to put money in the market. And the easiest way is the 401k because it's coming out of their paycheck beforehand. And when they don't have to see that bottom line or have to spend that money, it makes it a little bit easier for them. And I get that. I totally get that. Now, I'll say this. If you are at least 59 and a half or older, there are tons of alternatives with your 401k. You could come to me. We could sit down and talk about all the different things you have at your disposal. Because in your 401k plan, you're dealing with what they offer you within your plan, right? You can only invest with what they offer you to invest in. Now, I'm here to tell you, if you're 59 and a half or older, or you're separated from your employer, as in you lost your job, or maybe you took an early retirement and you're under 59 and a half, all of those folks, you have the ability to talk to me about your 401k plan. You have the ability to roll your 401k plan to something that I could propose for you within a traditional IRA, or even if we wanted to go the Roth route. So one of the things I'd like to discuss with you is I am one of only 300 advisors in the country that uses a group called Market Guard. Now, what I like about Market Guard is they have a very low expense ratio. And if anybody understands expense ratio, it's the cost you don't see. Okay. Now, I'm also an advisor that charges an external fee, a fee you do see, right? But you know what? We're actively managed portfolios within Impact Partnership Wealth. That's our wealth division. So what does that mean, Randy? It means simply this, that we move funds around more often than passive advisors. So could we be a little bit more expensive? Sure, possibly. But you know what? We save people money on their expense ratio most of the time. Not all the time, but most of the time. So what I'm going to tell you is you have incredible opportunity putting your money in the market with us. Now, if you want to get more conservative and you want to get, let's just say you want some preservation tools in your portfolio, we can talk about multi-year guarantee annuities, which are very similar to CDs. Or you could look at fixed index annuities. And folks might come to me and say, well, you know what? I got in one in 2019, or I got in one in 2020, and it hasn't performed. Well, folks, if interest rates were low and you got into those, you should come talk to me right now, because there are ways to get out of those contracts, and there are way better contracts out there with better rates out there. And Randy, I know you know this to be true.
Well, one of the things about a 401k is when you look at what you have there, it's basically built for growth. And, you get into a 401k when you're in your 20s or your 30s or your 40s, and that's what you're really interested in. It doesn't probably have for you someplace to build income. It doesn't give you that opportunity to say, I need some preservation as opposed to growth, and you don't have those opportunities. But Mark, you said that you can move your money out of your 401k over to your own IRA. Can you still participate in your 401k because maybe your employer has a match and you kind of like that? That's free money. Do you have to roll all of it out, or can you roll some of it out and still take advantage of your employer benefits?
That's just, I'm so glad you brought that up, Randy. That's one common misconception. Folks think, oh my gosh, if I roll it over, I'm done. Well, I'll just say this. Most plans allow you to roll over the entire amount and keep your account open and continue to contribute to it. So, if you want to move a portion, or if you want to move all of it, most of the time this is available. And so, this is the phone call we make. If you have a custodian like Fidelity, or if you have a custodian like Charles Schwab, or whoever it might be out there, we call them. We ask these questions. There's full transparency here. So these conversations have to happen. But where does it all begin, Randy? It all begins with, what do you want to know about your plan? Because you know what? Number one, if you show me what you're invested in, even if you're stuck in that plan and I can't do anything for you, I can give you some helpful free advice, okay? That's one thing. I understand these funds. I know how they work. I can run a report for you, because that's where we start. We start with a diagnosis of a report. If you want to send me your brokerage statements or your 401k statements, or whatever you've got in that situation, I have a secure upload on my website. My website is moretoretire.com. It's just the acronym for the Mark Ostler Retirement Experience. It's moretoretire.com, and I have a secure upload. You just let me know you send it to me. And then, of course, there's also a submission form, and you could tell me on the submission form as well. It's on the front of my website on moretoretire.com. You just scroll to the bottom and you submit that form. I'll get that. I'll get the secure upload, and we'll go to work for you. What I want to do, Randy, is provide information for folks, make sure they're the most well-informed about everything they have. And the one thing I can tell you is, if a person comes to my seminar, or if they come into my office, I will spend as much time as is needed so you are well informed about the choices you need to make.
I think it's so important. So many of us have 401ks. This is what we're bringing to our retirement. And you think sometimes you're just stuck there. And all I can do is what they provide for me. Well, the fact of the matter is, at 59 and a half, this is an age where you can start to move things around, and it doesn't have to be a taxable event. And you can open up the world of options to you within your 401k. So give us a look on our website, moretoretire.com, moretoretire.com, or give us a call, 984-300-1984. That complimentary meeting, we'll sit down and talk through what your concerns are. 984-300-1984. Everybody's talking about AI and ChatGPT and all these different things now, and we're using it for some things, and some things it doesn't work out so well, but you're probably experimenting with it as well. This I thought was kind of interesting. Yahoo Finance asked ChatGPT an interesting question. If you make $60,000 a year today, how much will you need 20 years from now? All right. Their answer that came back was $108,000. In the math, that's an 80% increase over 20 years. And I thought to myself, I wonder if that holds up. So I went back to 2005 and I looked at the price of eggs and the price of butter and the price of a Ford F-150. Okay. I don't know how those two things go together, but anyway. And you know what? That 80% actually tracks. So you talked about inflation just a moment ago. This is something we really have to home in on with a retirement plan. What you need today is not going to be what you need 20 years from now. So how do you build rising income, progressively greater income in your retirement plan?
You know, this is one of the big things that we have to address and we have to talk about. And it's particularly about inflation. If you are not keeping up your income with the rate of inflation, then you're falling behind. So if we decide this is the income you need in retirement, let's just say it's $6,000 a month. and you've decided, oh, here's my $6,000 a month. I'm going to tell you in 10, 20 years, that's not going to be enough if that's what you're looking to spend because of inflation. So how do we go about this and make a difference here? We build in inflationary measures. So for example, some folks say, I do need to set up some type of lifetime income. Now, before, a lot of people would pick immediate annuities because immediate annuities would be very similar to what pension programs would be within workplaces. And we know that a lot of those have gone away. Now, you don't have to pick an immediate annuity. You could pick a deferred annuity that provides a lifetime income rider. It could be a single one, meaning for one person, or it could be for a joint life. Usually the joint life pays a little bit less. But the advantage of doing a deferred annuity with a lifetime income rider is it provides this lifetime income. And then at the same time, if you don't use it all, you're still providing a death benefit to your beneficiaries. And the advantage of it is you're not stuck as it just being income. It's still an asset. So if you wanted to change something about the program or do something different in the future, you can. So it's flexible. You have the ability to do things differently. But there are ones that have inflation protection. It could be based on a simple roll-up, or it could be based on indexing. So say, for example, Randy, it's a fixed index annuity. There could be several different indexes within that annuity that we allocate to. Now, if we take those allocations and let's just say they went up by something like 5%, we're just throwing a dart at a dartboard, right?
Okay.
Then what happens is the following year that index increased by 5% based on how this particular product works, your income increases by 5%. So that's what we want to accomplish. We want to pick something that whether it's index inflation or whether it's simple inflation, it provides the extra income you need in retirement. And if you're not doing this right now, I'm going to tell you, you need to do this and you need to talk to me about it, because if you haven't made these plans or put them in place, why don't we start this 10 years ahead of time and not wait until retirement?
You know, and Mark uses some terms sometimes I want to clarify when he says rider. Here's my definition of a rider, okay? If you order a cheese pizza, you're just a plain old cheese pizza, okay? It's going to be $15. And then you say, well, I'd like some pepperoni on that pizza. Oh, that's a little bit extra. So now it's $18. And I'd like some mushrooms on that pizza. Okay, now it's $20. You're adding something in. So an annuity product will give you income in retirement, but you have the option to add in some little extras, a little cheese, a little mushroom, a little pepper, whatever you want to do there, and give you rising income in your retirement years. It's as simple as that. And Mark could explain that in probably much better terms than I just did right there. But you can give us a call and we can sit and talk about your paycheck in retirement. You get a raise in your job, maybe it's 2% or 3% or whatever it is each year to fight inflation. Why don't you do that in retirement too? Let's talk about it. MoreToRetire.com is our website. And when you go there, you're going to see our 5 steps to more. And you'll find out what the whole idea behind what Mark does. You'll also see down at the bottom of the page a place where you can put some information in. That way, Mark will reach out to you. Or you can reach out to us right now. 984-300-1984. 984-300-1984. You can also find our podcast. If you're listening to this show and you want to hear a little bit more, you got to get out of the car. I get it. That's okay. Listen on your own time. And you can find our podcast on iTunes and Spotify, your favorite podcast provider. Just look up the Mark Osler Retirement Experience. All right. The people at Morningstar took a look at how people are investing their 401k. Where is your money allocated in that 401k? And they found that last year, $4 trillion with a T, $4 trillion are in target date funds. Those are the ones that have the year in back of them. You're probably in one. The idea is that as you get closer to that date, closer to your retirement, your money gets a little more conservative. It goes more toward bonds than it does into the market. Well, some people like them, some people don't. Carrie Hannon over at Yahoo Finance is a big fan.
But what I love about these and why they're so great for many investors is like when the markets go jangly, we don't sit there and worry because these are kind of balancing, diversifying your investments in a way that so you don't have to be panicking and you know that they're going to rebalance in order to keep you focused on what the goal is.
When the markets go jangly, that's a very deep financial term there, okay? All right. So, Mark, I know that this is part of the analysis. You go into the 401ks, you find out where people have their money and say, this is working, this is not, this is good, this is not, back and forth. Do you find a lot of people are using target date funds, and are you a big believer here? Is there a better place to put our money?
There's a lot of people using target date funds. Randy, I don't know if you knew this or not, but I had some money in target date funds in the past in a 401k. Don't currently, but I can tell you it grossly underperformed how the market did, whether it was S&P or NASDAQ. And I wouldn't advise it for anyone. So if you've got it, all you have to do is show me what you've invested in. We can look at your returns. We can run a report. We can answer questions. And then I can tell you what you could do differently within that program if we can't do anything outside of it. Okay. Number one, I am not a fan of target date funds. I just think they underperform. And even when the market has a downturn, I don't think it really saves them people as much money as they say that it does. But I would love to have a candid conversation about numbers and figures with Carrie, because I just don't see it.
So she's implying that as the market goes jangly, as she says, the target date fund is adjusting. I don't see that. You talk about active management. I don't know that there's active management in target date funds, is there?
No, there is not. It's passive, Randy. I mean, they'll rebalance more than anything else. And we know within our market guard model, when we rebalance, it's not just rebalancing. We're changing up positions. And that just occurred, over the last quarter. So I know that changes and takes place because, for example, when I looked at financial services and percentage of the model had in financial services for our market guard opportunity model, it was over 34%, and now it's down to about 30%. So it changed a lot. I mean, these things change all the time, and we add and change these weights and measures ourselves as well, and we help people make decisions based on what we think can help them in their particular situation, might be a benefit to them. So we'll give you advice, of course. It's going to be good advice. We give good advice. But what I'm going to tell you is if you have a target date fund, come meet me. I'd be glad to give you free advice. No, you don't have to do business with me. It's not a big deal. But I can tell you that at some point you're going to want to do business with me because I know what I'm talking about. I know I can give you the best information out there and the resources out there for what you want to accomplish.
One of the things I think about with these target date funds is a little bit of marketing. I don't know if it's a Ronco commercial from the 70s or anything like that, but I think that the idea seems so simple and so good that as you get toward retirement, we de-risk your portfolio and you don't even have to worry about it. We do that all for you. Sounds like a great idea, but in practice, I don't know that they're really coming through, because if you look at target date funds right before the financial crisis and right after the financial crisis, I don't know if you're going to find that it did exactly what they said it's supposed to do.
No, when you saw market dips and you've taken the numbers and the figures, and I'll do this for the person, when they come in, we'll go over the figures. I mean, it's not hard to research it and figure it out. But, generally speaking, when you looked at some of the past downturns and go back to the 07-09 period of time, and we go back to 2000 and 2002, we know the S&P 500 from high to low dropped 49% from 2000 to 2002. From 2007 to 2009, we know it dropped 56.5%. During those times, there were certain drops. I know in 2008 there was about a 35% drop or so, and I just didn't see the big protection or preservation, because there's definitely no preservation tools about it. It seemed like it dropped almost the same way. So for me, I would like to do things differently. If you're going to take on risk, I'll give you an example. We want to spread the risk amongst a lot of different sectors. Then we want to make sure that we make adjustments and changes throughout. And this way we can keep down your standard deviation to a level that's comfortable for you, because I've met with people that have a standard deviation that's quite high. And
right, now, before you go any further,
yes.
Standard deviation, let's bring that down to the third grade Randy level here. That's the wobble, right? The wobble in your portfolio?
It is. I mean, it's when you look at it, it's the level of risk. The beta is the full-on risk you're taking.
Okay.
For example, with a beta, S&P 500 is a 1. So in our market guard opportunity model, I know the beta is below a 1. And you say, wow. Well, how is that possible? Because of how it's spread out and how it's diversified. And that's really important to understand. So can we keep a high Sharpe ratio? A Sharpe ratio is how you have your returns based on your level of risk as well, right? And then the alpha is the excess return. Are you outperforming the benchmark? We answer all of these questions. So Randy, my father told me one day, he looked at me after we had a great conversation similar to this, and he said, "You know what, Mark? You're smarter than you look."
It's like people look at me and go, "You got a face for radio."
I think I do too, probably.
I love it.
But
Hey,
truly, Randy, I mean, it's just, bottom line is I spent hours doing research about 25 different positions of stocks and ETFs that have outperformed the market as well. So if you want to talk to me about that, I'd love to share it with you.
Let's talk about your 401k. Let's sit down. I mean, this might be where all your money is, and you want to make sure that it's performing the way you want. You want to make sure that it's doing what you want it to do for your retirement. And let's dig in there and find out exactly what's going on. And just the whole concept of it gets less risky as you get toward retirement. That's a good thing. But is it actually doing it? And if it's not, is there a better way that you can? And have Mark help you with that. Let's have that discussion. Give us a call. Give us a look on our website, moretoretire.com. Very simple, moretoretire.com. As you go there, you go down to the bottom of the page. You'll find a place where you can put a little information there and reach out to Mark with your questions about retirement, your questions about your 401k, and let's get those answered for you. 984-300-1984 is our number, 984-300-1984. All right, so the Department of Labor had a pretty interesting, they do a lot of studies and things like that, and this I thought was very interesting about retirement. They were talking about fees and the things that get in the way and pull at your money. You know, we talk about markets, and we talk about taxes, and we talk about fees, and we talk about all these different things that are grabbing at your money in your retirement years, including you, because you're going to spend some of your retirement money for sure. The Department of Labor said 1% in financial fees can lower your retirement savings by 28% over the length of your retirement. So I think about that. You bring in $1 million to your retirement. It's in your 401k. You lose 25% of it to taxes. You lose over 25% to fees. All of a sudden, you're down 50%. You haven't done anything yet, and you only get to enjoy $500,000 of your million. That just doesn't seem right. Now, Mark, when people walk in your door, are they prepared for this? I mean, this is what you do, and you say, okay, there's a lot grabbing at your money. We got to put up the shield and try to make sure that we can fight this off. Do people realize this is happening?
Yeah, I don't think so, Randy. And then that's the thing. So, for example, we build in all the structure of whatever fee you're dealing with. You'll see all the fees. We're going to discuss them. We're going to talk about them. We're going to be transparent. I had folks come to me and say, well, my broker is charging less of a fee than yours. I said, okay, let's see what he's charging. Let's see where the positions are. Let's see what the underlying expense ratio is, because that's where you're getting charged and you don't see it. And then let's add it all up together, because guess what? There's a lot of times that people are breaking even or getting charged a less of a fee just by working with me. And I'm active, and most of those advisors that are working with you are probably doing passive positions. I can't say for sure, but I can look at it and see, and you could tell. If you just set it and forget it and you don't make changes too often, then you know it's passive. So let's have these conversations, because when you get feed to death, I mean, it gets difficult. You start seeing the difference. I'll give you an example of fixed index annuities that have bonuses. Some of them have fees attached, some of them don't. Some of the indexes have fees attached, some of them don't. We can analyze the difference between adding the fee or not adding the fee. I can tell you if it's based on the bonus and you're paying, let's just say it's a premium bonus. And a premium bonus immediately applies to the death benefit of the product. So if a person passed away and it's a premium bonus, immediately the death benefit's increased by that amount. If you have the higher bonus based on the fee that's attached to it, I just ran a comparison with a company with the higher bonus and the lower bonus, one with the fee, one without the fee. And over a 10-year stretch, the one that had the lower bonus but without the fee came out to be a little bit greater than the other one. And so if that's over 10 years, then over 20 years, it's going to be even more significant. And this is important to understand because we're not looking at it from what are you returning? We're looking at what you're net returning. We want to know what you're netting out because if this is planned for income as well, this is important. We just talked about inflation a little bit ago, right? And we want to make sure that we're netting enough money. So that involves taxes too. So we want to make inflation provisions and income tax provisions. And of course, we involve all the professionals, the CPAs and the attorneys for the estate planning. But what I can tell you, Randy, is absolutely, if you get feed and it's affecting you by that much, we can diagnose that and we can answer those questions here.
In your life, if you're paying a fee for something, you have to ask yourself, is it worth it? Okay, what am I getting for what I'm paying? I think I've said this before. I have a lawn service. I have the deal of the lifetime. It's $30 a week, and it's been that way for years. Now, if they just came and mowed my lawn for $30 a week, it would probably be worth it because I don't want to do it. But these guys, they do weed control, they do fertilizer, they do my bushes, they blow the leaves, as well as the edging and all this stuff, and I get it all for $30 a week. And it's really worth it for me to pay that. You have to say that, and you have to come to that place in your mind where you say, what I'm paying is worth it. And you have to know somebody who's going to be transparent in their fees and tell you exactly what you're getting for what you're paying. That should be a part of your relationship with your financial advisor. Give us a call, talk to Mark, and let's find out if you are a good fit. Here's our website, and here's our phone number, moretoretire.com. moretoretire.com. There you'll see our process. There you'll see a place where you can put in some information. And let's just start a conversation about your retirement and how it's all going to work and get your questions answered. Here's our phone number. It's 984-300-1984. 984-300-1984. Somebody wrote into the MoneyWise advice column and said, I'm going to push my Social Security off, but I'm going to draw from my 401k to let that number get bigger. And he says, is this a good move or a bad move? We'll look into it. Coming up next with Mark Osler on the Mark Osler Retirement Experience.
So, you go to the store to buy a shirt, and you find one you like, but they only have one size, medium. But you're not a medium. What do? Try to squeeze into it? That's not a good look. It's obvious that store and that shirt are not a good fit. It's the same story when people sit down with a financial advisor to plan for retirement. They may lump you in with everyone else your age with their standard cookie-cutter financial portfolio. Too complicated, too confusing, and too much risk in the stock market. It just doesn't fit. Mark Osler sees you as the unique person you are. Your hopes and dreams for retirement will be different from anyone else, and your financial plan should reflect that. Come see the difference with Mark Osler, where he looks at you as a person, not the number in your 401k. Call today for a free, no-obligation meeting, 984-300-1984. That's 984-300-1984 or online at moretoretire.com.
Welcome back to the Mark Osler Retirement Experience. Online, you can find us at moretoretire.com. If it's time to talk about how your retirement's going to work, you've been saving all these years, what does it mean as far as a paycheck is concerned? Then there's all these things about Social Security and Medicare and RMDs and your 401k, all this stuff about taxes in retirement. There's a lot. So let's sit down and have that conversation. It is 984-300-1984 to get started, or use our website, moretoretire.com. And Mark, you got an event coming up. Here we're halfway through July already, and tell me a little bit about what's going on.
Yeah, so next weekend, Saturday, July 19th, I will be over at Grace Baptist Church in Goldsboro. It's a Liberty First meeting, and I will be one of the speakers there. So if you want to show up, it's I believe, from 10 to 12, Saturday, July the 19th. That's 10 a.m. to 12 p.m. at Grace Baptist Church in Goldsboro. It's a Liberty First meeting, and I will be one of the speakers there. So if you want to meet me there, I would love to meet you.
So are you talking about money and biblical looks at money and that kind of thing, or what are we talking about here?
I always add some spirituality into it because, being a Christian and everything, it's important to me to talk about those things. But in general, we're really talking about what our government's doing and how our government is affecting, some of our liberty in general and what we could do about it differently as the people.
Well, when you look at it, and I don't know what the actual count is, but there's a certain amount of verses in the Bible about drinking, but there's a whole lot more about money.
Oh, yeah.
A whole lot more about money. And that's what we talk about here on this show. Okay, I'm going to go back to what I said before as we were going into the break. Somebody wrote into the Money Wise advice column, and they said they are going to start drawing off their 401k and push their Social Security off so that grows. And he asks, is this a shrewd move or a boneheaded choice? So how would you answer that one, Mark?
Well, I favor assets over income. I mean, it's important to build income, but if you're giving up an asset to just build up a bigger income stream, what if he dies?
Right.
He's not even going to get anything out of it. The advantage of starting Social Security early is that you started early. So you're starting to get that money. I was doing an analysis for someone the other day, and we were looking at the difference between, 65, 67, 70 years old. And you can see the cutoff, and I explained the cutoff to people. And the cutoff is when you finally got caught back up with the overage. Because let's just say you're getting $3,000 a month at age 67. So we take that. That's $36,000 a year. That's $108,000 over 3 years. And then you turn it on at age 70. Let's say it's $4,000 a month. So then we figure out when has the $4,000, which is $1,000 more per month, caught up to that $108,000 that you've already received. And that's the kind of math we're doing here. In terms of what this person's doing, I wouldn't do it. I certainly wouldn't do it. I would grow my money. I would turn on Social Security, and I would live a happy life.
Well, one of the things about it, you can think of it from a legacy standpoint. You can pass on your 401k. You can't pass on your Social Security. So that's one way to look at it. The other way would be is you take your Social Security early, and then if you're making a lot of income on the side, then your Social Security can be taxed. I mean, there's a lot to think about here, isn't there?
There is. And you know what? If they wanted to solve the Social Security situation, because we know that if something isn't resolved in the near future, that we could all have our Social Security reduced in the future. We know that the cutoff date we were looking at is somewhere around 2033. That's just where the trust fund would be exhausted. They're taking a lot of our Social Security taxes already and using it for people's Social Security payments. We know this, right? So they don't have enough money in the trust fund. So we know that if that ever happened in the future, so that's why a lot of people are turning it on earlier anyway, because they're like, well, if it's not there or if we're going to get reduced by 20%, at least I started grabbing it now as opposed to later. What I'll tell you is this. I wish our government would come up with a plan like they've talked about in the past where we just have a lump sum of money and I can build my own income stream and do my own investing with that money. I would love that. But that's just not going to happen right now because they don't have the funds to do that unless they want to pledge more money, right? So with regards to just, hey, should I push off my Social Security? Let's have the conversation for why not? Why not start your Social Security now? Why not start income now? Why not start retirement now? Because I had a client that when we met a little over 2 years ago, she's 59 years old. She's 61 now. She got laid off from a really good job. And you know what? We put provisions in her plan 2 years ago when I met her that if something happened, she could retire. And we just sat down the other day and she's talking to a recruiter and she's like, yeah, I guess I'm kind of retired unless I decide I like this new job. Well, if that's you and you've hit that place, talk to me because I'm telling you, I helped her back then and she knows she's flexible now. She's not hurting. She's not in a tough position. She's going to be in a place where if she wants to full on retire, and I think she's going to, she can do it. And we made those provisions a couple years ago. But if you give me 3 years, 5 years, 10 years, the more time you give me, the more we can make these provisions and make your retirement a reality.
Yeah, we talk about coming in a couple of years before you retire. A lot of people they wait until they're 3 months away and say, "Hey, I'm going to retire. How can you help me?" Well, we're going to help you. But at the same time, if you came in 3 or 5 years before retirement, that gives us time to really work on debt and work on all sorts of things and work on your Social Security strategy and have these things set up for you so that if something were to happen, as Mark just gave us a story about that, we would have a plan in place. Give us a look on our website, moretoretire.com. And when you're there, you're going to see our 5 steps to more. And Mark, why don't we go through that a little bit? Because I want to make sure that people know what happens when they call. It's really very informal. It's like God gave us 2 ears and 1 mouth, and we're going to listen twice as much as we're going to talk because that's really, really important.
It is. When you come into my office, the thing that I want you to realize is you're coming into a second home. Make it your home. Be relaxed. Be comfortable, because we're just going to have a nice conversation about where we go. So when you go to my website, More to Retire, and you go to moretoretire.com, and you'll find the pathway to more. That's just our process guide. It's under the tab process, okay? The first step is a treetop view. It could be one of 2 things. We could be combining step 1, treetop view, and step 2, discover your retirement desires all at once if you decide to give me your brokerage statements and other things ahead of time. Because one of the things we want to do if you have money in the market is we want to run a report to diagnose it. We want to answer all of these questions about the report, because you're going to say, what standard deviation, what Sharpe ratio, what is the expense ratio? Or maybe you know the answer to these questions. What does beta mean? We're going to answer all those questions for you. And when we answer those questions for you, it's going to be distinct, and you're going to understand exactly what you need to do in every given situation. So we could do 1 or 1 and 2 together. But what you do is you send me your statements on a secure upload. My secure upload is directly on my website. Now, on the pathway to more, we'll get to step 3, and that's personalize your retirement plan. So we want to personalize your retirement plan, and we want to make it customizable. So this way, that step 4 is your adjustments and changes. That's when you're already a client, but it's customizable. Everything can be changed in any given moment. And yeah, I would prefer to have an in-person appointment, because you know what? It's great. You get to know people. We have relationships, and my clients, they're family to me. They mean a lot to me. We care about each other. We love each other. So I'm going to be there for you for the years to come. And then, of course, step 5 is ongoing support. So if it's not me, it's somebody in the office making sure you're getting the support you need.
It is so important that you know that this is not a one-time transaction. You don't walk into Mark's office, set a plan, and say, shake your hand. Thank you very much, Mark. We're out the door. That's not how it works. It's an ongoing relationship, and that's really what you should expect from us as well. Go to our website and get going. It is moretoretire.com. Very simple, moretoretire.com, or 984-300-1984. All right, so the people at Yahoo Finance have their own podcast as well, and just recently they discussed the biggest mistakes that you need to avoid when you go into retirement. Number 1 on their list I thought was very interesting. It's underspending in the early part of retirement. There is so much in the news about the fear of running out of money. There is so much in the news about the 4% withdrawal rule. There is so much out there about you having a difficult time in retirement and you needed $1.5 million and you don't have it and you don't feel like you measure up. This is what it said at the end of the article. It said, if you die with millions in your account, your plan failed. Now, I can agree with that to a certain extent, but I thought it was really interesting, Mark, is the whole idea here, you save and you save and you save and you save, and you finally get to retirement, and it's hard for some people to get out of the saving mode and get into the spending and enjoying mode. But with an income plan and showing people that that bucket's going to get filled up every month, that should give people a little bit more confidence, doesn't it?
Yeah, absolutely, Randy. And I've been doing this as a whole. When we talk about, insurance products and things I've done when I first entered the business, I've been out at this for 24 years. And what I can say about that is that when we're discussing retirement mistakes, if I've been doing this 24 years, guess what? I've had clients that were born during the Great Depression. Mm-hmm. And I can tell you some of those clients, they just couldn't spend money. They really had a hard time. They were stacking it in the bank, and I get it. There's nothing wrong with the mentality of it. The question is, to what extent? So I want you to be able to spend in retirement and spend comfortably and not feel hamstrung. So are there going to be some situations where I'm worried about some folks where they might run out of money? Yeah, absolutely. But I'll tell you about it. But if I don't see a problem, I'll let you know that too. Now, if you want to leave a legacy, I get it. We can build that into the plan. But let's build a plan where you're comfortable spending, where you have enough income, you've prepared for inflation, you've prepared for taxes, and we've hooked you up with all the right people. And you know what else, Randy? If you have a business or you have a piece of property and you're really worried about the taxation of it by selling it because you might lose a bunch on taxes, well, we have professionals all around the country that can help with those things. They are very unique and they do things different. And I can tell you, with whether it's CPAs, attorneys, you'd be shocked at the things that we could do for you. I'd love to meet you and talk to you about it.
There was a commercial not that long ago, and it was always saying, I've got an app for that. I've got an app for that. Every question, I've got an app for that. Well, I'd like to think that when you sit down with Mark, we've got a plan for that. I'm scared I'm going to run out of money. We've got a plan for that. I'm scared I'm going to pay too much in taxes. I got a plan for that. Let's sit down and build your plan for your retirement. Give us a look on our website, moretoretire.com. Very simple, moretoretire.com. Place down at the bottom of the page where you can put some information in there. That'll trigger us to give you a call and ask you what you're concerned about. How can we help? Maybe we then sit down in the office and put the papers out on the table and say, here's what I've done for retirement. What's it going to get me? What does it mean for me per month in retirement? Let's get you the answers to those questions. It's 984-300-1984. 984-300-1984. I know it's hot as it can possibly be, and you're not thinking about football right now, but I'm going to give you a football story here. If you follow Washington, and this years ago, this was the Redskins, you remember the name Robert Griffin Jr. He was a quarterback for Washington, and in 2012, he signed a contract for $21.1 million, and $14 million of that was an upfront signing bonus, which means send me the check. Well, Robert said, send me the check. And when he looked at his bank account, he saw a deposit for $6.9 million. He was confused. He was distraught, he said. He called his agent and he said, what's going on? And his agent said, Robert, it's the taxes. He didn't know that was coming. So this is something in retirement that we're going to be dealing with in all different kinds of levels. Taxes on your Social Security check, taxes on your 401k, whether you withdraw from an investment account, capital gains taxes. There's all sorts of new things with the word tax that is associated with it. And I was just wondering, there are lots of different reasons to come seek out a financial advisor. Mark, have you ever had somebody get themselves into a tax fix and go, what happened here? I got to talk to somebody, and then they arrive on your doorstep?
Oh, yeah. Let's just talk about this for a minute here. I've had people come to me and say, oh, my gosh, I just sold this stock and I got hit with this capital gain. I didn't realize it was so significant. Or, oh, I just got out of this annuity contract. I didn't realize all the gains I had on this thing. And here we are with ordinary income tax, and I need to pay this thing. And these are the pitfalls we want to avoid. We want to talk about what taxes we want to pay, what taxes we don't want to pay. A lot of folks don't even realize the difference between CDs and annuities with the tax deferral nature as well. I discuss this all the time. And I said, well, my CDs grow and deferred. Well, I mean, it might be compounding inside of itself, but you're getting hit with the tax bill every year. So really, it's not compounding. But with regards to an annuity, it is. An annuity is going to grow tax deferred, and that deferral and compounding can really help some folks out. So that's another advantage. And then, of course, we talk about market money and equity ETFs, and they can have some tax advantages versus mutual funds. So all this knowledge is really important to have at your disposal. And if I don't know the answer to a question, Randy, I'm not going to give it to you. So RG3, I'm sorry you lost half your money on that signing bonus. I mean, truly, that was a rough one. He's good on TV. He's a good TV personality. He does a good job. I'm going to tell you something. If I hit the lottery, I'm probably still going to take the single sum, even though I know you can get a lot more money over a 30-year annuity. But I'm probably still going to take it because I'd rather invest it myself. And that's the truth of the matter. So when it comes down to taxes, it's just a matter of what you're willing to pay or not. But you need to have the knowledge ahead of time.
I think that we all want to be good Americans, and I want to pay what I'm supposed to pay, but I don't want to overpay. I don't want to make a mistake and overpay taxes. And I think that's key because, to me, taxes are April 15th and taxes are what come out of my paycheck. That's taxes to me. All right. But when you get into retirement, you just brought up a whole bunch of different things. Your Social Security could be taxed because of income difficulties. Your Medicare premium could go up because of income situations. RMDs, required minimum distributions. Sometimes people don't realize that there's an age that you have to start paying Uncle Sam. You have to start taking money out of that 401k and that IRA. Otherwise, you'll get taxed. So there's a lot to know here. And I wonder if people understand that if you were to look, I saw a pie chart one time and it said, here is where $1 from every retiree goes. And 30% of that pie chart was taxes. Yeah. And that's in retirement. I don't think people realize that, do they?
No, they don't. A lot of times folks don't realize that there's a good distinct possibility your taxes could be higher in retirement. And this is something we should talk about ahead of time. It's something we should discuss in advance because you don't want to get hit with a surprise, especially when you're retired and you're working off of what you think is a fixed income. And now all of a sudden you're getting hit in the belt, right? And if you have to take money out of the accounts you're drawing out of, that's a double whammy because now you're going to have to take out a higher percentage just for income. So these discussions are really important. And you brought up required minimum distributions. We call them RMDs. RMDs are when you've got let's just say a traditional IRA or you had a 401k, just sit there on the sidelines and you're retired. And let's just say you're born in the years 1951 to 1959, we know that those people are turning on required minimum distributions where the government says you have to take a certain amount out of that asset and pay taxes on it. Usually starts a little bit less than 4% and slightly increases each and every year. That happens at age 73 for people that were born from 1951 to 1959. But it happens for people at 1960 or after that were born at age 75. Okay, this could always change. This was based on the laws of the Secure Act and the Secure Act 2.0. There's a lot of folks that don't realize that when they're passing on IRA money, if you're not passing on to your spouse, a non-spousal inherited IRA has to be exhausted within 10 years of the death of the person. So when we say that, they also have to take at least a required minimum distribution as well. Now, there's nothing wrong with doing it that way. You're spreading it out over 10 years. But even if you're exhausting it and you're paying taxes, you can reinvest that as well. There's a lot of different things we can do. But if you've got a taxable situation you don't know about ahead of time, because most of the time you do, let's have these discussions now and not later. Yeah,
best we talk about the tax time bomb sometimes of that 401k in your retirement. Let's handle that tax. I would say that this way: a retirement plan isn't a retirement plan without a tax plan. That's the best I can do there. Give us a call. Let's talk through it with you. If you have a 401k, there is a tax element you have to deal with. Let's get it out on the table. MoreToRetire.com is our website. MoreToRetire.com or 984-300-1984. 984-300-1984. Now, I saved this story for last purposely because I don't know where, as you're listening to us, where you get your financial news. It could be CNBC or Fox Business or Bloomberg or Yahoo Finance or Kiplinger or Motley Fool, wherever it is. You're going to see all sorts of stories about the market and where they think the market's going. And they'll put people on there that'll give you all sorts of different opinions. Now, this is Peter Schiff. Now, you may not know that name, but he's a pretty big dude. He's a billionaire stockbroker, investor, and he handles an awful lot of money. And he was asked where he believes the economy and the market is going.
Lower interest rates are not the solution to our problem. They are the cause. The reason we have so many problems is because the Fed left rates so low for so long. So the solution involves much higher interest rates. Now, I understand that's going to be very painful given the economy that we've created built on a foundation of cheap money. It means stock prices come down, real estate prices go down, companies fail, there's going to be bankruptcies, there's going to be defaults, there's going to be a protracted recession, probably a much worse financial crisis than 2008. But all that has to happen, because the alternative to that is even worse.
Holy cow. I mean, there is a war going on about interest rates right now. President Trump believes that interest rates should be lower, and he's going after Jerome Powell. And Jerome Powell says, no, we're data-driven, and the data says we need to hold steady if we even are going to lower rates. He wants to raise rates, and he says if we don't, we could be headed for another 2008. Now, as a person just watching TV and hearing that, I'm like, holy cow, 2008 was like the worst. And he's saying that might be in our future. When a client comes in and says to you, this is what I've heard, what do you say? I mean, it could really affect their investment decisions. How do we work through this kind of stuff?
So how old are you? You know, that's one place we get to. How far are you away from retirement? Because when you're younger, you're in that accumulation stage of your life. You're trying to make as much money as possible. But you get to a point where maybe you've accumulated enough that you're comfortable, where you want to preserve a little bit more, and then you want to distribute it to yourself at a certain date. So that's when we have to say to ourselves, do we want to add some preservation tools into this plan or not? Because yes, we've talked about this on our show left and right. I don't care how much Donald Trump's going to knock at that door for Jerome Powell, unless the numbers tell us that inflation is coming down, he's not going to lower interest rates, right? It's just not possible. And every time we think it's going to happen, it's not happening. It's because we truly haven't leveled off, Randy. And he's saying you raise interest rates because you want to combat that with the inflation and how everything else we're feeling. And I get that. But where it's hitting home, where it's hurting the most is commercial real estate. Because we know that $1 trillion of commercial real estate is coming due through 2024 through 2026. It's right around $1 trillion. It's like $990 billion, okay? We know where interest rates are now versus where they were 5 years plus years ago, right? They're much higher. And because of that, you're seeing either companies going out of business or folks just not renewing their leases. I had a Lowe's Foods right down the road from me that they just chose not to renew their lease. And I know why. Because it's a lot higher of a rent. Why? Because most people are leveraging their money when they have commercial real estate, and they need to make sure that they can cover everything. So, yeah, this is a real topic of discussion, because could it be a 2008? It's possible, because when you have problems in commercial real estate, it trickles down to residential. And we know we had a housing crisis back then. So the people with cash are going to be king in this situation. The question is, do you want to just be taking on full levels of risk at this point in your life, or do you want to add some preservation tools? And we can add preservation tools in there, Randy. I mean, within a brokerage account, you can pick things like structured notes, and there are some out there that have some preservation tools. And then if you like annuities and you want to build in income planning or future income planning, or you want to build in just some safe, we'll not call them safe, we'll call them preservation tools within the annuities alone. Because within an annuity, let's say it's a fixed index annuity, it might have 1 or 2 year periods of reset. Reset means where you get a return off the index and it locks in. So I'm telling you that unless there's a fee on the contract and we're not counting in the surrender charge schedule, that you have gains that lock in and then they stay there. So that's important to understand, because that's a preservation tool as opposed to you dealing with the ups and the downs of the market.
As we get closer to retirement, the idea usually is let's back off on the risk. Let's go more toward preservation. There's the accumulation stage, there's the preservation stage, and that's really what we're talking about here. Let's sit down and talk through it with your particular situation. Let's talk about your 401k, what you've done for retirement. It looks like a great number to you right now. If it doesn't go backwards, well, let's talk about that whole idea. Give us a call. Give us a look on our website. It's moretoretire.com. Moretoretire.com. Bottom of the page there's a place for you to put some information there, and Mark will reach out to you, and let's talk through it. Let's get your questions out on the table. If you like what we sound like and we like what you sound like, and we seem to be a good match, let's sit down in the office and put the papers out on the table and start the discussion from there. You can give us a call at 984-300. 1984. Well, thank you for listening to the Mark Osler Retirement Experience. If you liked what you heard and you want to hear more, don't forget to like and follow us on your preferred podcast app, and we'll see you next time on the Mark Osler Retirement Experience.
Insurance products are offered through the insurance business Mark Osler Retirement Experience. Mark Osler Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Mark Osler Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Mark Osler Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Mark Osler Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.